Hey guys, how you doing? It's Savolia, and we are on day 5 of building your wealth system, and I am so excited about today. Before I jump in, if this is your first time joining my channel, I help women build a wealth system in faith, fitness, food, and finance because we are meant to be more than just mothers, daughters, and wives. We're meant to have peace, purpose, and prosperity, right? And so while this channel is dedicated and tailored for women, I believe it can help anybody out there just trying to understand how that they can be the best version of themselves to pursue that peace, that purpose, and that prosperity. I really encourage you to go back and look at days 1 through 4 if you want to find out more. But today is day 5, and day 5 is develop financial literacy. This is a good one. Let's get right into it. And you know me, I like to start with high level stuff. So what is the big picture? Why does financial literacy matter? Well, number one, they are not teaching us this stuff in schools. So we need to make sure that we're looking out for our own finances because no one's going to do it better than us. And it actually is not that difficult. Despite popular opinion or what's out there, all the ways you can invest, all the different types and markets to watch and day trading. And it doesn't need to be that time intensive, and it doesn't need to be that complex. And so I'm really hoping the goal of this video is to simplify financial literacy and to give you some good tips and tricks and places to start with where you should invest. Okay, so high level, I'm working off a sheet. This is my resource. I created this. It's investment tips is what I call it. And so I like to first start with saving versus investing. Okay, because we like to think of these as two different things, but really a part of financial literacy is rethinking how you save, because saving is truly investing at a very low interest rate. Think about it. When you put your money into a bank savings account, what is the bank promising you? They're promising you anywhere between 0.01% rate of return on your money to maybe even as high as 4% if it's a high yielding savings account. That is investing. That is putting your money somewhere where you get a little bit in return for holding that money in that place. Okay? And if you're putting it in a place like a checkings account just for emergencies, I want to encourage you to rethink that, because inflation right now, as of, let's see, the last time I looked it up was December 2025, and inflation was at 3%. So US dollars are currently, devaluing at a rate of 3%. That means if you're putting your money in a shoebox or a checkings account or even a savings account that's less than 3% rate of return, then you're actually losing money over time. You're not saving. Having a checkings account can be great for a place for money to flow in and out of. You need a place for your income to come in, and you need a place for your bills to go out. So having a checkings account does serve its purpose, but I highly recommend that is the purpose it serves, not for anything more like compiling cash. Okay, so the first step is rethinking how we save. Considering inflation, you want to make sure your savings are in a place that's at least 3% or more rate of return so that you're not losing money, as we've talked about. The next important thing to consider are risk levels. Everyone has different risk levels that we're comfortable with, right? And that's honestly for you to decide. And I'm not here to tell you where you should put your money or where you shouldn't. I'm just here to talk about the different risk levels to consider. All right, so I am going to go through the most common investment strategies, not necessarily strategies, but places to invest, the most conventional places that people invest their money. But before I dive into that, I want to talk about how we're going to evaluate each of these different investment strategies. All right, so 4 things to think about when you're considering where to invest your money. You want to consider liquidity, and you want to consider safety, that's risk. You want to consider rate of return, and lastly, you want to consider taxes. So whenever people are talking about, let's say the stock market, they're like, well, I would rather put my money in the stock market than in a savings account because I'd rather have the potential to make 5, 10, 15, 20% rate of return. That is the big thing that everyone wants to think about. Well, what's the rate of return? And then they assess if that's a good investment or not based on the potential rate of return. That's one thing out of 4 parameters to consider. While one investment opportunity may have a great rate of return, it may have really high risk, or it may have very poor liquidity, or it may have really poor tax opportunities, tax savings. So is it really a good investment if you're getting taxed like regular income tax? You don't have any access to that cash. It's locked up and it's a high risk or medium risk or no risk. How great is that rate of return then? It's not for me to tell you, it's for you to decide. But we're going to look at all 4 parameters for each of these different investment opportunities. All right, guys, the first investment opportunity, stocks. What are stocks? Stocks is owning a stock is owning a portion of that company. And depending on how many stocks you own depends on the amount of equity that you hold, equity ownership of that, percent of ownership in that company. And stocks are advantageous because if the company performs well, then you could receive a greater value for your stocks. On the other side, if the company performs poorly, you could lose money. That's the risk, right? And then some stocks even have a dividend component where they share in the company's profits with its shareholders. Now, companies that have stocks means they're publicly traded companies. They're publicly owned. And so these aren't private companies. They're like the mom and pop business. You can't purchase stocks in it. You can purchase ownership directly with the owner, but that's different. We're talking about publicly owned companies that have stocks available in the, like, for example, S&P stock market, right? And so liquidity. Yes, you absolutely have liquidity for owning stocks. You can access that money at any time and pull it out. Safety. No, I would say that it's not necessarily unsafe. It's not necessarily safe. It depends on the type of company that you're investing stocks in. Rate of return. Absolutely, I would give this a thumbs up. Yes. While you can lose money in a stock, right, that rate of return can go down to below 0 and it can be negative. They tend to, over time, if you long-term hold that stock, over time, stocks, historical rates have shown that stocks actually perform pretty high on average. Now, this depends on the company you're in. So I recommend, pick companies that have been around the block for a long time, or choose companies, maybe different companies that you're comfortable with. Some smaller companies, some larger companies. The offside with those large companies, those growth companies, is that you have to pay a lot more for that stock. So the opportunity to make more money is more expensive because each stock costs more. All right. Next, we've got taxes. Now, I would say semi on this. I would say semi. And the reason is you are taxed on stocks, typically taxed as long-term capital gains if you're holding that stock. But there are some instances where you can be taxed as ordinary income, depending on which tax bracket you fall into, if you're trading that stock often. whether you want to be a day trader or not, that's not really what this video is about. But I will say that, there's a lot of speculation in day trading, and even the best traders are speculating to a certain extent. And since the goal of this video is to encourage simplicity of investments, simplicity of investing, then, it's not simple to constantly be trading and watching the stock market. It's better to long-term hold your investments for long-term gains. All right, guys, so that's stocks, bonds, and certificate of deposits. That's the next investment opportunity that we're looking at. And quickly, bonds are loans that bonds are loans that government or companies give to individuals and promise a certain fixed interest rate of return on that money until maturity. And certificates of deposits are similar, but they're more like bank accounts where you put your money in with the bank and they promise you a certain interest rate fixed until that CD, that certificate of deposit, reaches maturity. Sometimes CDs are considered safer because they're FDIC insured since it's with a bank, but both are definitely locking in your money for a fixed agreed upon period at a fixed interest rate. Now, let's talk about liquidity. No, absolutely not. We just said that bonds and CDs, they lock your money up for a certain amount of time. You cannot access that investment until that investment reaches maturity. That bond, that CD reaches maturity. All right, safety. Yes, bonds and CDs are considered pretty safe. Nothing in life is a guarantee that you're not going to lose money. Anything can happen in the economy, but for the most part, bonds and CDs are considered safe. So I'm going to give that a yes. Rate of return, no. Now, maybe once upon a time, there were government bonds that were pretty decent rate of return, especially compared to where inflation was at. But the last time I checked, bonds and CDs were commonly below the rate of inflation. That means the interest rate, the fixed interest rate they promised their investors after that investment reached maturity was below 3%. And therefore, like we've talked about, you are losing money if you invest in any investment opportunity that's going to be lower than the current rate of inflation. So make sure you know what inflation's at. It's around 3% right now. And make sure that whatever investment opportunity you're considering is going to outpace inflation. It doesn't matter how safe it is. It doesn't matter how liquid it is. And it doesn't matter how tax haven safe it is. If you're losing money, you're losing money. And how is that a good investment? Okay, so rate of return, no. And then taxes, no. There isn't any like tax safety with this investment. When that money comes back to you, you are taxed. Like I said, look at your tax bracket, look at the specifics of wherever you are, because you may not be taxed like ordinary income, but I honestly do not know as much about bonds and CDs, so I'm not going to claim to know the tax rate. I just know that you are taxed when that bond and that CD reaches maturity. But I'm going to give it a no because you are taxed. Mutual funds. Our next investment opportunity, mutual funds. And a lot of people talk about mutual funds as a great investment opportunity for people that really want to simplify investing, because you own think of it as a bucket of stocks in one fund. So you own a little bit in a lot of companies in one fund. So it's how you can diversify your portfolio. It's a great way if you're not sure what the market and you don't have time to watch the market, because even if some of those companies in that fund start to tank, the likelihood is that at least some of them are going to perform well, or perform decent. And so they can kind of balance each other out. That's why people like mutual funds. But I am going to say huge recommendation, if you don't research anything else in this video, make sure you look at this, and that is look at the expenses on those mutual funds. I personally do not invest in mutual funds. I invest in index funds or ETFs, because ETFs and index funds are just like mutual funds in that you own a little bit in a lot of companies. But the thing is, these are passively managed, whereas a mutual fund is actively managed. And think about it, when it's actively managed by an individual or group of individuals, they need to get paid. They need to get paid for managing those funds. They're oftentimes trading a lot of different companies in and out of that fund a lot. And so it increases the expenses of it. And so just look at your mutual fund. I personally don't invest in any fund that's going to be more than 1% expense ratio. And I'm really looking for more like 0.05% expense, because you would be surprised in how expenses can eat into your profits over time. Let's look at liquidity, right? Mutual funds, index funds, ETFs, liquidity. Yes, I definitely give it a thumbs up. You have access to that money. You can pull it out at any time. You're not locked in for a preset period. It's absolutely liquid. All right, let's look at safety. It's semi-safe, because you have the opportunity, you can still lose money, because it's so many companies, the chances of that happening are pretty slim. And like I said, they can kind of balance each other out if some companies in that fund are performing poorly and some are doing well. Rate of return, absolutely yes. I give that a thumbs up, just like stocks. Rate of return is good with funds, mutual funds, index funds, and ETFs. All right, so let's look at taxes. Now, the tax details for mutual funds can get a little complicated. So when you sell your shares in a mutual fund, an index fund, and an ETF. when you sell, you can be taxed differently. And this is why I'm saying semi, guys, because it really just depends. If you're selling them, you're going to be taxed more. If you're holding them, you're still going to be taxed, but not quite as much. That's the general rule to consider. But when you sell, and you sell for any shares that you've held for 1 year or less, those gains are taxed as ordinary income. When you hold for more than a year and then you sell shares of that fund, then your gains are taxed as long-term capital gains. And that can be 0, 15%, or 20%, largely dependent, I believe, on your tax bracket. So make sure you look at what your long-term capital gains are at based on what you make on your regular W-2. Consult your CPA. All right, let's go to the next one. Investment grade life insurance. Now, I called it investment grade life insurance because life insurance can be used as an investment. And if you are going to do that, you do have to stay within certain guidelines that the IRS has set, because they realize that people try and use life insurance as investment opportunities. And so they set rules to keep it below a modified endowment contract. Those are all just fancy words to just make sure that you find an agent that is experienced with investment grade life insurance, because not all agents, trust me, as someone who's bought a few policies for my own life to use as an investment, I've learned that not all agents know about this, and I found myself literally educating the agent I was buying it from. Properly structured, overfunded, high cash value life insurance gives you a huge bucket. It can have the potential for a huge bucket if you continue to pay your premiums that bucket of cash accumulation starts to compound grow at a certain rate of return. What that rate of return is highly depends on the insurance company that you're working with. Some are more generous than others. And if it's a mutual insurance company, then they will actually share their profits with their policy holders via dividends every year. If it's not a mutual company, and then you're not receiving dividends, there's no possibility of receiving dividends. If it is a mutual company, only certain insurance products actually share their dividends. This is another big important thing to keep in mind. And those tend to be their whole life policies. So if you have a whole life policy, you can receive dividends over time, more and more and more, because the more cash value you hold, the more they pay you in dividends each year. Even if it's a mutual company, but say you have an index universal life product, a lot of people like this because your money is tied to the stock market, but it's not being invested directly. And so you have the potential for a higher rate of return. But these index universal IUL products, they do not share their dividends, even for mutual companies. That's not always a bad thing. It's just something to consider, and maybe talk to the agent you're working with and ask them to show you both products for a mutual company. Ask if it's a mutual company, and then ask them to run illustrations on a whole life product and an IUL, and just compare over time what you could receive. But if it is a whole life policy, it does need to be set up in a way where you receive the maximum amount of dividends that you can receive. All right, so let's talk about liquidity on investment grade life insurance. Absolutely, yes. The liquidity is phenomenal. This is why I have these products for myself, because I can access my money whenever I want, and I can either take a loan or take a withdrawal. Always take a loan. If you want to learn more, I'm definitely gonna put another video about investment grade life insurance specifically. If this is something that interests you, let me know in the comments. But it is absolutely liquidable. Now, depending on how much you're funding your policy, it might take a year. It might take a year. It shouldn't take more than that. If it's taking more than that, then your agent set up your policy the wrong way. But a properly structured policy, you can have access to your money within a year. Now, safety, absolutely, that money is safe. No matter what policy you hold, whether it be a whole life policy, an IUL policy, a universal life policy, it is safe. The insurance company promises to never lose your money in exchange for you having a policy with them. All right, so rate of return, semi. And I say semi because number one, it depends on the company you're working with. And number two, it depends on the type of policy you have. Universal life policies, whole life policies, what else? Fixed policies, which is really just a whole life policy. These type of policies are basically policies where the insurance company is taking on the risk. They're saying, we promise you, no matter what happens in the market, no matter what happens in the economy, no matter what happens with our investments, we are going to guarantee you this 3, 4, sometimes even as high as 5% rate of return. Not that crazy, right? They're taking on the risk, so they tend to be more conservative. But you're promised that no matter what happens in the market. Now, if you have an index universal policy or a variable life product, life policy, then you are saying, I'm taking on the risk. I'm taking on the risk, and therefore I'm choosing what my money is being invested in. If it's a variable life policy, then your money is being invested directly in that market, and it can lose money. I know I said that life insurance can't lose money, but I don't recommend going with variable products if you don't have investment experience, because that is the one life policy where you can actually lose money. Now, index universal life policy and IUL, you can't ever lose money, and your money is tied into the stock market, whatever index you choose. Because it's tied in and not invested directly, that's why you're guaranteed to not lose money. But because you're taking on the risk, there may be some years where you're making a 0% rate of return if the economy performed poorly. My current index universal life policy is performing at a 9% rate of return. So that's just because of the index I chose and the insurance company I chose to work with. So the rate of return is semi. It can be pretty great. So whatever policy you choose, just keep in mind you want that if you do use this investment opportunity, you want an agent that knows how to set up investment grade life insurance properly. And you also want to make sure that interest rate, that's if it is fixed, is going to be higher than 3%. All right, last thing, taxes. Yes, absolutely. Taxes are incredible with investment grade life insurance. This is why this opportunity is one of the most underrated investment opportunities and misunderstood opportunities out there. You got people like Suze Orman and Dave Ramsey that are just crapping on these products, and they're right, they are expensive, and they're right, you can lose money if you have an interest rate promised to you lower than inflation and expenses being so high. You're losing money at that point. Or if you have a variable life product and it's being invested in poor investments in the stock market and you're losing money, that can happen. That's why just like not all stock companies are created equal, not all insurance companies are created equal. And there are places you can go where you can look up ratings. I recommend Wise Ratings, WEISS, and research that insurance company, and they'll give you a letter of performance, A, B, C, they go B minus, C minus, etc., B plus. But just look at that website, check it out. There are other platforms, but that's the one I use. That's the one I like the most, and I find least confusing. But check it out, and then don't believe everything Dave Ramsey and Suze Orman tell you, because just like any investment, there's going to be some upsides and there's going to be some downsides. Nothing is a perfect investment, but the risk and the liquidity and the rate of return and the taxes, that's up to you to decide what you want to consider for yourself. So investment grade life insurance has excellent taxes. This is because when you take loans out to access your cash value, it's considered a loan. You are not required to pay any taxes on a loan. All right, that's how that works. Now, if you are taking a withdrawal, then you could potentially have to pay taxes. Now, the nice thing with life insurance is that when you take a withdrawal, it's considered first in, first out. I believe that's what it's called. But the way that works is your premiums that you paid into that policy, those are post-tax dollars. Those are dollars you've already paid income tax on. Therefore, you're not required to pay tax again. So when you take that withdrawal out, your cost basis is what's taken out first. And only when you exceed that cost basis, it's when you're subject to income tax. So essentially, you're only subject to income tax on the money you make in that policy. But the first dollars that you withdraw are going to be those premium dollars. That's just the way it works. It's really awesome. It's really amazing. I still don't recommend you take a withdrawal, but some people, if they want to use, investment grade life insurance for their retirement income, which is absolutely a great choice, they may take withdrawals up until they get to that cost basis number, and then they start taking loans. One of the advantageous things about taking loans on your policy is not only do you not have to pay taxes on it, but your repayback period is entirely up to you. Some people, they never repay back the loans on their life insurance policy. They just make sure there's enough cash value and in that bucket to keep the policy active. even if they're not paying premiums anymore. There are so many ways to set it up, and it can get really complicated. So I'm not gonna get into all the ways on this video, but essentially what you need to know is if you decided to not pay your loans back at all and you just took out loans while there was still enough cash value to keep your policy active, then when you die, simply whatever loan balance you had gets deducted from the death benefit that gets paid to your beneficiary. So for example, typically loan rates for insurance companies are anywhere from 2% to like 6%. You want to know what your rate on that loan is, and you want to know what rate you're making on the cash value. So for example, if your insurance company charges 5% interest rate on all of your loans annually, and then they're also paying you 9% on your cash value, then that 9% is always going to stay ahead of that 5%. Does that make sense? So even if you never pay back that loan, you should still have enough cash value in there to keep that policy active, and then also your death benefit, takes care of the balance. It's really amazing. It's awesome. This is definitely one of my absolute favorite investment strategies. All right, guys, we have more investment opportunities to go through. We're going to go through real estate, equity in a house, because that's two different things, real estate and equity in a house, cryptocurrency, high yielding savings account / money market funds, Roth IRA, traditional IRA, 401k, 403bs. We're going to talk about those different investment opportunities in part 2 of this video. I really, really love this stuff, and I don't want to shortcut the information I share you, but because it's just so much information, we're gonna break this up. Come back for part 2 if you want to hear more about developing your financial literacy.